Imagine a world where you can get any loan you want at a low interest rate. That's possible with a high credit score. Welcome to the world of credit scores, a world that can open doors to financial opportunities or slam them shut. It's like a magic number that lenders, landlords, and sometimes even employers look at to assess your creditworthiness. A credit score ranges from 300 to 850. The higher the score, the more financially trustworthy you appear. A good credit score? That's usually anything above 700. It means you're more likely to secure that dream loan or credit card with lower interest rates. But what if your score isn't where you want it to be? Don't fret. Credit scores aren't set in stone. They're like a financial reputation. And just like any reputation, they can be improved. Now, how does one increase their credit score? Let's dive into the step-by-step process. The journey to a high credit score begins with understanding your credit report. Now, let's delve into what this mysterious document is all about. A credit report is a detailed record of your credit history compiled by credit bureaus. It's like a report card of your financial behaviors, reflecting how well you manage your debts and pay your bills. It's the foundation of your credit score, a 3-digit number that lenders use to determine your credit worthiness. To access your credit report, you can request a free copy once every 12 months from each of the 3 major credit bureaus: Equifax, Experian, and TransUnion. This is a right granted to you by federal law, and it's an important step in taking control of your financial health. Once you've obtained your credit reports, it's crucial to review them thoroughly. They contain a wealth of information, including your personal details, credit accounts, payment history, and inquiries made on your credit. You're looking for any inaccuracies or discrepancies that might be dragging down your credit score. If you spot any errors, don't panic. You can dispute them directly with the credit bureau that issued the report, and they're obligated by law to investigate your claim. Now let's talk about the factors that affect your credit score. They can be broken down into 5 main categories: payment history, amounts owed, length of credit history, new credit, and types of credit used. Payment history is the most significant factor, accounting for about 35% of your score. It's followed by amounts owed, which makes up about 30%. The length of your credit history, the new credit you've applied for, and the types of credit you use, each contribute to the remaining 35%. Understanding these factors can help you pinpoint areas for improvement. For example, if you're frequently late on payments, focusing on making timely payments can have a significant positive impact on your score. Once you've reviewed your credit report, it's time to start improving your credit score. So, let's move on to the next step: paying your bills on time. The easiest way to start improving your credit score: pay your bills on time. It sounds deceptively simple, doesn't it? But it's a proven fact. Regular, timely payments are a clear indication of financial responsibility, and that's exactly what credit agencies want to see. Let's take a moment to delve into why this is so important. Every time you miss a payment, it's a red flag to credit agencies. It signals financial instability and can cause your credit score to take a hit. Even one late payment can have a negative impact, and several late payments can cause significant damage. But here's the good news. Each on-time payment you make is a step in the right direction. It's like climbing a ladder, one rung at a time. And over time, this consistent pattern of timely payments can help repair and improve your credit score. So remember, consistency is key. Consistently paying your bills on time can make a significant difference in your credit score. Reducing your debt is another effective way to boost your credit score. You see, a critical factor that affects your credit score is your credit utilization ratio. This ratio is the percentage of your total available credit that you're currently using. For example, if you have a credit card with a limit of $5,000 and you've charged $2,000 on it, your credit utilization ratio is 40%. Lenders and credit bureaus typically like to see a credit utilization ratio of less than 30%. Why? Well, a high ratio indicates that you might be over-reliant on credit and could be at risk of defaulting on your payments. A lower ratio, on the other hand, suggests that you're using credit responsibly, which can positively impact your credit score. So how can you reduce your debt and consequently lower your credit utilization ratio? Here are a few strategies to consider. Firstly, Create a realistic budget and stick to it. This will help you to live within your means and avoid unnecessary debt. Secondly, consider using the snowball method, which involves paying off your smallest debts first to gain momentum before tackling larger ones. Alternatively, you could use the avalanche method, which involves paying off the debts with the highest interest rates first to minimize the total interest you pay over time. Thirdly, consider consolidating your debt with a lower interest loan or balance transfer credit card. This can make your debt more manageable and potentially save you money in interest. But remember, this strategy only works if you refrain from accruing new debt while paying off the consolidated debt. Lastly, make a habit of paying more than the minimum payment due each month. This will help you to pay off your debt faster and will also show lenders that you're committed to reducing your debt. Remember, every step you take towards reducing your debt is a step towards healthier finances and a higher credit score. Reducing your debt not only improves your credit score but also eases your financial burden. Building a long and healthy credit history can significantly improve your credit score. Now, that's a statement that carries a lot of weight. But what does it mean exactly? Let's break it down. First off, let's talk about the longevity of your credit history. Credit bureaus love stability. They want to see that you've been responsible with your credit over a long period. This means, paradoxically, that keeping old accounts open, even if you don't use them much, can be beneficial. These older accounts contribute to a longer credit history, showing you've been in the credit game for a while and know how to play it right. Then there's the diversity of your credit. Just as a balanced diet is healthier than gorging on one type of food, a mix of different types of credit can be healthier for your credit score. This could include credit cards, retail accounts, installment loans, finance company accounts, and mortgage loans. Of course, this doesn't mean you should rush out and open a bunch of new accounts. That could actually harm your score. Instead, gradually add different types of credit as and when it makes financial sense for you. It's also important to remember that while building a credit history is crucial, it's not a quick fix. It's a marathon, not a sprint. It takes time and patience, but the effort is well worth it. A robust credit history can open doors to lower interest rates on loans and credit cards, better chances for loan approval, and more negotiating power. Finally, it's worth noting that building a credit history isn't just about the past. It's also about the present. It's about showing that you can handle credit responsibly right now, not just that you've done so in the past. So keep making those payments on time, keep your debt levels low, and keep your credit utilization rate in check. A long and diverse credit history can work wonders for your credit score. So start building that history today and watch your credit score climb. Improving your credit score might seem like a daunting task, but it's achievable with consistent effort. Our journey today has taken us through the essential steps to lift your credit score from the doldrums and set it sailing towards a brighter financial future. First off, we ventured into the depths of understanding your credit report. It's like a financial mirror, reflecting your credit behavior. By comprehending what's in your report, you can identify areas that need improvement and spot any errors that might be pulling your score down. Next, we focused on the importance of paying bills on time. It might seem like a small thing, but timeliness can greatly impact your credit score. It's like a testament to your responsibility and reliability. Remember, every on-time payment is a positive mark on your credit report, and each one helps to build up your credit score. Then, we delved into the world of debt and how reducing it can positively influence your credit score. It's like losing weight. The more you shed, the healthier you become. Lowering your debt not only lightens your financial burden, but also shows lenders that you're capable of managing your finances well. Lastly, we touched upon the importance of building a good credit history. It's like a resume to potential lenders, showing them your financial habits over time. A longer, positive credit history can boost your credit score, making it easier for you to access better financial opportunities in the future. In summary, improving your credit score is not a one-time effort, but a continuous journey. It's about understanding your credit report, making payments on time, reducing your debt, and building a good credit history. It's a journey of financial discipline, perseverance, and patience. Remember, a high credit score opens the door to many financial opportunities. Start improving your credit score today. Because a better credit score means a better financial tomorrow, and you have the power to make that tomorrow a reality.